What's up guys, Ron from Ronald Law, and in this video, 5 minutes, I'm going to tell you exactly what to look for if you're analyzing or underwriting a triple net investment property. Now, I'm going to assume that you're familiar with a triple net lease. You kind of understand the basics of base rent and then additional charges for taxes, ad valorem taxes, insurance premiums, and any operating expenses or CAM charges. But what are the three things that are critical when I look at an industrial property and I'm looking at the triple net component? What do I look for? Okay, this can make or break your lease. All right, so for people that don't know, my name's Ron. I'm an industrial investor and commercial real estate attorney here in Dallas-Fort Worth. And in this video, I'm talking about three things to look for when you're underwriting your next triple net investment. So they're incredibly powerful tool, and I think for people that don't really understand the benefit of triple net, I'll describe it as the easiest way to cap your downside loss and to cap your upside increase as well. And so let me just say that again, because it's really important to understand it's not all sunshine and roses. You know, multifamily or gross leases, they have the benefit of being able to mark to market, that is, raise their rents or decrease their rents as it may be on an annual basis. And they take all of the risk of increasing rents over a long period of time, as well as the risk of increasing expenses in that same time period. Now, in the multifamily world, that's produced a lot of huge wins. You have people making millions and millions of dollars in just a short few years as rents increased. However, in the triple net world, you don't have that phenomenon. If you are buying a stabilized existing property, your income is capped by the terms of the lease. However, your downside is also capped from property taxes increasing, insurance going up. The tenant still pays that. However, their base rent amount won't increase until they have a renewal at fair market value, or maybe their lease term expires. The most important thing is to look at the net effective rent. This is called NER, and what it does is it really encapsulates the impact of property tax increases, insurance increases as a burden on the tenant. Now, I think I mitigate this, and people on Twitter talk about it, that it's so important in Texas or Florida where the taxes are going up. I say as an investor, I really don't care. And it's a little bit deceiving because, yes, I don't care in the immediate sense, and I do care in a net effective rent in terms of competing properties. But at the end of the day, the tenant is in a better position to raise his prices to the consumer, and he knows what the consumer can bear based on the increase in expenses from property taxes than I am. And I don't want to be a judge of how to pass increases, and I want to pass that risk over to the tenant. Now, on the flip side, that decreases my downside, but it also limits my upside. The way you look into this is you look at their ability to pay. So you're going to want to look at tenant financial statements. Maybe you have tenant sales reporting. Maybe you have publicly traded companies you can see. And ultimately, you can look at what their industry is. You want to look at their outlook for their future growth and what do these industry businesses typically pay as a percentage of rent. If you're in that low 10, 15, 12% of revenue, you have room to grow, and they can even weather increases in property taxes. However, if you're in an industry where their rent cost is closer to a third of their revenue, you're going to have trouble passing on increased property taxes, and you've got to be mindful of that net effective rent and how price sensitive that tenant is to an increase. Number two, lease terms. You've got to make an abstract. You've got to read each lease from start to finish, because I see a lot of clients, they bring a deal to me and they say, Ron, you know, I've already looked at the leases. Everything looks good. Or they'll say something like they're all the same. What I find is that is never true. There is no such thing as identical or two commercial leases which are the same. They just don't exist. It never happens. There are always little changes, and you've got to be able to look for the changes and decide if they're important. So, for example, lease duration and renewals. A lot of people will say that a tenant has a 5-year lease and then a 5-year renewal. But in reality, a renewal only benefits the tenant. If the landlord wants them to stay, if they're going to give them good terms, the renewal is a limit on the landlord's options, and it is solely a benefit for the tenant. I don't care what anybody says. If the tenant wants to stay, if they want to renew, they're going to keep renewing regardless of whether they have an automatic exercised option or not. So I'll say it again, renewals hurt the landlord and they only benefit the tenant. Finally, you want to look at rent escalations. I think that this is one of the biggest ways that people overestimate, or they'll be more cavalier about flat rent or maybe bumps after 5 years. What it means is that the timing of the rent increases limits when you can sell the property. Because, for example, if there are rent increases after 5 years, I would say almost guaranteed you have to hold the property for over 5 years to get to a place where another investor wants to buy that property, because a lot of people don't want to buy flat rent. And so if it's every 2 years, you're going to have to sell the property on every even year, right? It's not going to be an option where you could sell every single year, because there is meat on the bone with rent escalations on an annual basis. Finally, property due diligence. This is hard for me to explain, but it's something that's really critical, and that is matching the lease to the physical property. And what I mean by that is reading the terms of the lease and seeing what they're getting rights to, what they're getting access to, and what they're ultimately paying for as it relates to how the tenant is actually using the space. And there's a lot of scenarios, especially in industrial, where somebody is maybe paying for less and then they just park their equipment on a broader field. Maybe they're only paying for 1 acre of outdoor storage, but they're spreading their trucks across 3. These are really critical differences that are opportunities for you to either charge more to the tenant, maybe squeeze them back into 1 acre and then lease out the other 2 acres. But it requires you to read the lease and compare it to the physical condition of how the tenants are actually using the space. So that's it for this quick video on what to look for when you're underwriting a triple net industrial lease. Smash that like button and subscribe for more commercial real estate content.